Hey, just a note to you podcast folks, we just came out with a retirement income guide, and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities, and interest-bearing accounts, and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. What's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax.
Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
Really excited about our next guest. It's my finance guy, Paul Winkler, joining us live on YouTube and Rumble and on the FM dial. What's up, Paul? How are you, man?
Brother Chris, how you doing, man?
And I'm excited to have you on the show because I have no idea what this news means.
Yeah.
I'm very, very confused, and you're the guy that breaks this stuff down for me. So let's lay out the story, and then I want to get your instant reaction, okay?
Sure.
Yesterday, Donald Trump signed this executive order, and it's paving the way for crypto and alternative assets to be added to 401k retirement saving plans, okay? Mm-hmm. The order directs the Secretary of Labor to re-examine the Department of Labor's guidance on fiduciaries' duties regarding alternative assets investments in ERISA-governed 401k and other defined contribution plans, and to clarify the Labor Department's position on alternative assets and the appropriate fiduciary process associated with offering asset allocation funds containing investments in alternative assets. This is why we have you on, Paul. Can you tell us what that means in English?
Yeah, in English. So a lot of people, they go to work for a company and they don't know what to do with their investments, so they just choose defaults like target date funds or asset allocation funds, which is just a fancy term for it's investing in different areas like bonds and cash and stocks and typically things like that. Traditional investments, that's what it is. Now they're saying, hey, we're going to let you do these other things. And that's where this stuff is appearing, is in asset allocation funds and target date funds. That's where they're actually going to be doing that. And so that's just it. It's just opening up. Wall Street is like crazy excited about this because they get to charge more now, because these typical assets cost a lot more to hold. So, they've been having this price war where fees have been coming down and down and down and down. And now they're like, hey, how about if we offer this thing and then we can charge more for it? They're excited about it for that reason. As far as for the investors, I'm not terribly excited. And, there are two sides of this.
Okay, tell me. Number
one, if we look at the pros, we say we live in America. We're free to make mistakes. We're free to make decisions on our own. And that is kind of the idea. Maybe a pro of this was people will learn a valuable lesson when they screw up and they invest in these things. Number one. But the other issue is that, government has never really, this isn't anything new, government has never really protected people from their own dysfunction. Now, if you look back through history, in the 1960s, they had the Tronics craze. If you threw Tronics at the end of the name of your company, it was good for a boost in your stock price. Okay. And then you had energy stocks, and then you had bonds in the 1980s, then you had the tech bubble, then you had the real estate craze, and you have meme stocks. And so government never really has protected people, but this is just another level of that with private equity and, private equity and collectibles and those types of things being held in 401ks. I'm not a big fan. I'm really not a big fan of this at all.
Is there any way that this helps your average investor, though?
Not really. Not in my humble opinion. No. So if we look at collectibles, we look at, let's say, Bitcoin or gold or silver or anything like that. There's no cost of capital. There's nobody paying you to use your money. And that's what investing is by definition. Somebody has to be paying you, and there's no payment here. Number one. Number two, the other issue is that, like, if you deal with private equity, there is payment for the use of money, but there's a thing about private equity, that's a big, big problem. I did a study, and I did this on the radio show, and I went through private equity, all the open funds out there through Morningstar's database. And what I found is that if you looked at 10-year, 5-year, 3-year, 1-year performance in every time period, you actually had an underperformance versus the S&P 500 with private equity investments. And you go, well, what the heck is going on here? Why? And the reason is private equity is what? Private. So when I buy a public stock, let's say I buy Apple or I buy Amazon or I buy, Walmart or, just pick any company, I know what to pay for that company. I know what to pay because I kind of know what the earnings are going to be because all that information is public. I can get access to it. With private equity, you don't have that information. And that's why they like it, is because they don't have to give out any kind of information. So you don't know what to pay for it. So that's the problem you run into with these things. If I look at stocks, the price of a stock, this is going to get a little nerdy, but the price of a stock is the present value, or what the present value is of all the future earnings that are going to come in. So, if I say that I'm going to give you, Chris, I'm going to give you $1 1 year from now. And I'm going to give you $1, and the rate of return, I think, is going to be about 10%, seems to be a reasonable amount of return. And that's all I'm going to give you. You'd be willing to pay 91 cents right now to receive $1 a year from now. That's basically the present value of that dollar a year from now, right?
Okay.
Now, if I don't know what the earnings are going to be because we don't have any information, I don't know what to pay for it.
Right.
And if all of a sudden now you have these 401ks and you have all this money coming out of people's paychecks going into private equity or private investments, now Wall Street's going, yeah, man, this is great. We're going to get a bunch of access to money. And what that does is it reduces the cost to use your money because they've got access to more of it. So what does that do to future returns? It reduces them even more. So you see that this is why I'm not a big fan of this kind of stuff.
So, and we're talking with Paul Winkler, who's my finance guy. He hosts the Investor Coaching Show every weekend here on Super Talk. It's a great place to start learning. That's actually where I first found you, Paul. And me and my wife would listen to your show. But you manage a lot of 401ks. Are you going to be using the private equity, the real estate? Is that something that you're going to dive into and try and find a positive benefit? Or are you going to stay far away?
Not at all. I'm not going to use it at all. And now, real estate, if you look at the real estate part of this whole thing, if you think about it, when you own companies, Ray Kroc, McDonald's. Yep. He basically was asked, hey, you got a hamburger company? He's like, no, I don't have a hamburger company. I've got a real estate company.
Side note, the founder about that, the founding of McDonald's, underrated movie with Michael Keaton.
Oh, fantastic. Yeah, that's so a great watch.
So good.
Yeah, super, super good. So if you think about it, when you own stocks, you have lots of real estate in your portfolio already. Why do I need to load up on it? And this is private real estate. So now we're dealing with more uncertainty in that, but I don't even hold real estate at all in a 401k. And then private equity, no, I don't see any good reason to own that either. People say, oh, it's diversifier. And I'm like, well, if you look at matter of fact, there's a really good article in the Wall Street Journal. And Jason Zweig wrote this, and it was, you're invited to Wall Street's private party, just say you're busy. He went through the data, and it was like, yeah, I totally agree with him on that. I don't think that the data is compelling, and the problem is you just have something else in your portfolio. You don't know what the heck it is.
So what's the thought process behind the executive order then? I've heard rumors on the internet that private equity is in big trouble. Is that part of the thought process behind this? What's the rationale, I guess?
Well, think about it. If private equity is in trouble, why is it in trouble? Because the returns aren't that great, maybe. Maybe that's a problem right there. You have this concept of an accredited investor. And the idea behind an accredited, you hear hedge funds. People hear about hedge funds all the time.
Right.
The hedge funds, and these people are really, really wealthy and blah, blah, blah. Well, hedge funds charge a ton of money. They have this 2 and 20 rule, so they charge a 2% management fee and 20% of gains and stuff like that. Well, an accredited investor is all who can invest in these things, which means it's a wealthy person. And what I joke about on the radio show is the reason that accredited investors exist is because basically Washington or the government says, hey, you know what? These people have enough money that they can afford to lose it. It's not great. So if we look at the idea of opening this up to the public, now you have a whole group of people, and maybe it's possible that wealthy people are getting onto this and they're going, yeah, maybe this isn't so great. And now they need more access to money. But in reality, what they could be doing is saying, hey, you know what? There are other ways to raise money. Let's look at going public and, actually become more public, because the number of public companies have been shrinking. But yeah, it's not, I'm not compelled to jump into this in any way, shape, or form.
Well, what are you going to do then? With the state of the economy where it is, what's your assessment of it, and what moves are you making to get the greatest returns?
Yeah. So number one, I don't make moves based on what I think is going to happen in the future. We look at this year so far and we say, okay, we have a president that came in and says, let's make America great again.
Yeah.
And nobody in their right mind would think that the highest performing area of the market so far year to date would be international small distressed companies.
Yeah, it's
They're
really
up
weird.
like 30%.
Why is that?
Yeah, why is it? Is it partly, and it's been said that maybe part of it is that Europe is going to have to defend themselves, and defense stocks are up as a result of that. Is a result of just, when I was studying at Afama, the guy I studied under who won the Nobel for economics, this is back in the late 90s, and he says, to diversify, you need these areas. You need small companies, you need large companies, you need international small value, and he made that point in the classes. And we were looking at him going, Professor Fama, you've got a 5-year return of that area of the market of zero, nothing, no return. Are you crazy? And he goes, well, that you're assuming that area of the market won't have to pay to use your money going forward. And that is not a good assumption. The reality of it is that could take off. And it did. He was right. I mean, not that he was betting that was going to happen, but it went up fourfold over the next 10 years, where large U.S. stocks did nothing. So that, in and of itself, you look at international companies and say, why is it that area is doing well? Well, you say, well, because for the past several years they haven't done anything, and maybe it was just their time. And you can't predict this stuff. And that's the problem with most investing, is really trying to predict the future and figure out what's going to happen next and make moves based on it. And I look at it and go, you have no idea. If I go back 60, 70 years, and I say, well, what was the return of large U.S. stocks? It shocks people when I tell them the return was about 10% per year. Go back 40 years. Now, 40 years, we're looking at $10,000 growing to about $500,000. You're trying to get a higher return than that when you're playing around with these strategies. You take the same $10,000 and put it in small U.S. stocks and international as well, you're looking at somewhere in the neighborhood of about $1 million. And you go, well, why are people complaining? Why do they want access to something more than what they're getting access to right now? And my contention is that they're saying, I want a different vehicle because the vehicle I've been using, my experience in the stock market has been bad. And my contention is the reason your experience has been bad is you've been trying to time the market. You've been trying to engage in, what they call fundamental analysis, stock picking, trying to figure out which company's better than others. You've been pulled by tech stocks. You've been pulled by oil stocks. You've been pulled by energy stocks. You've been doing all of the wrong things. It's like you're driving a car, and every time you get to a traffic light, you run the light. Of course, you're going to have accidents. You break the rules. And that is one of the rules of investing, is not to engage in those things. And yet this order is allowing people to do more of that. But I'm just going to say that, this isn't anything new. I'm not going to say, hey, Trump's terrible for doing this. I'm not going to say that, because the government has never protected investors. The idea of a fiduciary is the idea, hey, you know what? We're going to be a fiduciary. We're going to keep your best interest first. And the standard is so stinking low that it is so bad that I'm looking at it going, this doesn't help anything, because what constitutes prudent investing isn't actually happening. And people can still call themselves fiduciaries. It just drives me crazy.
We're talking with Paul Winkler. He's my finance guy. He hosts the investor coaching show here every weekend on Super Talk. What grade would you give the Trump economy thus far?
I think there are a lot of great things going on, really. I think a lot of exciting things going on. Now, that doesn't translate to necessarily higher returns in stock markets or anything like that. And that's a mistake people make. They think, good economy equals good stock market. Because you had, during Obama, remember, you had a terrible economy. And yet the stock market was raging hot, did really, really well.
Say the same thing about Biden.
Yeah, sure you can. Yeah, no question about it. So, you look at it economically and go, yeah, there are a lot of exciting things going on. There are some scary things that can be offsetting. And a lot of people out there are going to go, yeah, AI, what's it going to do to my job?
Yeah.
Is that a possibility? And there is a transition process. You've got to go through that process of moving from the way things are. Anytime you have new technology, it's disrupting, right?
Yeah.
So that's kind of what a lot of people are going through right now. But, I think overall there are a lot of really good things going on.
When you see $17 trillion of investments coming into this country, as an investor, what does that signal to you? Does it signal anything?
Well, it's interesting you say that, Chris, because there was something the other day talking about, I forgot what company it was, and they were talking about half a trillion was supposed to come in, and they only had only 100 billion, but there wasn't as much coming in, so it really. The time will tell how much actually comes in. And you and I have had this conversation before where I said, hey, who's going to work these jobs? That's one of the things that I'm wondering about. And maybe AI is going to be the savior when it comes down to new jobs that are created where we don't have the people to fill them. And maybe that and technology and productivity things, equipment and machinery and things like that are going to be developed and brought to the United States. So that's really where I think is exciting. And change is always exciting. I look around and go, wow, people get scared about change. I look at it as opportunity.
Yep.
I'm a hopeless optimist when it comes to that.
Well, Donald Trump has given a lot of reasons to be optimistic about the future of the American economy. We're talking with Paul from Paul Winkler, Inc. He's my finance guy. I appreciate you taking some time today to come on and break down that executive order. How can we get in touch with you and keep up with you, Paul?
Yeah, so paulwinkler.com is the website, and people can jump on there. They go, hey, we got 10 offices around town. They can jump on with a 15-minute phone call with other people. And then my book is on there, Confident Investing. Confident Financial Planning is another book that I have on there. We got all kinds of stuff out there. Videos, tons of audio, and then they can sign up for the podcast as well.
Well, Paul, I really appreciate it. Looking forward to your show tomorrow, as always, and thank you for stopping by the show, man. Really appreciate it.
Thanks, Brother Chris.
Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation. This interview is not a paid endorsement. However, the interviewer has received compensation from Paul Winkler, Inc. in the past, which we disclose in the interest of transparency.